NVIDIA is no longer a GPU company. It sells entire AI factories. In the most recent quarter, CY 2026 Q1, revenue hit $81.61 billion, up 85% year-over-year. Data center continues to drive the majority of growth. We'll dissect the business model shift, the moat, the ASIC threat, and the real risks. The core change is the product. NVIDIA moved from selling individual GPUs to selling complete rack-scale systems. A single GB200 NVL72 cabinet costs between $2 and $3 million, compared to about $40,000 for a single B200 GPU. That's an order of magnitude jump in average selling price. This shift redefines NVIDIA's economics. It's no longer a hardware vendor but a systems integrator with software attached. The latest reported gross margin of 74.9% in CY 2026 Q1 demonstrates the pricing power. Let's quantify the price leap. The average selling price per GPU equivalent rises dramatically when you sell a full cabinet. If a single B200 costs $40,000, and a GB200 NVL72 contains 72 GPUs, the per GPU price in the cabinet is roughly $30,000 to $40,000, similar per chip. But the total system value is much higher because you're also selling networking, power, and software. The formula for system revenue is units times average selling price. When you shift from one GPU to a full rack, you multiply revenue by the number of GPUs per rack, even if per GPU price stays flat. NVIDIA's moat isn't just one thing. It's 3 layers. First, CUDA. Over 18 years, it's accumulated 5 to 6 million developers. Migrating a large AI training stack to AMD ROCm or Intel One API means rewriting code, revalidating models, and risking performance regressions. That can cost months and millions. Second, full-stack hardware. Blackwell integrates 36 Gray CPUs and 72 Blackwell GPUs in one liquid-cooled cluster. NVIDIA is the only company with 3 networking businesses, NVLink, InfiniBand, and Spectrum-X Ethernet. Networking revenue has surged, with the company reporting substantial growth in fiscal 2026. Specific figures need current verification. Third, customer lock-in. Major cloud providers have orders booked into 2027, and sovereign AI revenue reportedly topped $30 billion, up over 200%. Let's model the switching cost. If a company has invested in CUDA, the cost to switch to another platform includes engineering hours, validation time, and potential performance loss. A simple formula: total switching cost equals engineering time times hourly cost, plus the value of delayed deployment. For a frontier model, that could be several months and millions of dollars. This is why CUDA's moat is sticky. Even if a competitor matches paper performance, the ecosystem inertia is a powerful barrier. The market is splitting into 2 segments. Training stays with NVIDIA because of CUDA and the full-stack system. Inference, however, is repetitive and cost-sensitive, making it ideal for custom ASICs. Google's TPU, Amazon's Trainium, and Microsoft's Maya are all targeting inference. TrendForce projects custom ASIC shipments will grow 44.6% in 2026, nearly 3 times the 16.1% growth of commercial GPUs. This is the key competitive threat. NVIDIA's pricing power in inference is eroding, even as it dominates training. This chart shows the projected shipment growth for custom ASICs versus commercial GPUs in 2026, according to TrendForce. ASIC growth is 44.6%, nearly 3 times the 16.1% for GPUs. This is a structural shift. As inference workloads explode, ASICs will capture an increasing share of the market, pressuring NVIDIA's long-term pricing power. NVIDIA faces 4 real risks. First, customer self-design. The biggest customers are the most motivated to replace NVIDIA. ASICs will erode market share in inference. Second, supply chain concentration. NVIDIA relies on TSMC for advanced manufacturing and SK Hynix for HBM. Packaging capacity constraints and HBM shortages have been a concern, though the situation may improve. Third, export controls. NVIDIA reportedly took a $4.5 billion charge for H20 inventory, and fiscal 2027 Q1 guidance assumes zero China data center revenue. Fourth, valuation and cyclicality. AI capex is highly cyclical, and the stock is priced for perfection. Let's do some valuation math. NVIDIA's trailing P/E is 34.26, but forward P/E is 16.88. That implies the market expects massive earnings growth. If we assume earnings grow at 50% per year for the next 3 years, the forward P/E would compress significantly, possibly below 10. But if growth slows to 20%, the forward P/E would be around 20, still reasonable. The question is whether the market has already priced in the high-growth scenario. Given the stock's market cap of $5.27 trillion, even modest multiple compression could cause significant downside. Here are the key financial metrics for the most recent quarter, CY 2026 Q1, as verified in the latest fact packet. Revenue surged to $81.61 billion, up 85.2% year-over-year. Gross margin remained robust at 74.9%, and net margin reached 71.5%. Operating cash flow was $50.34 billion, and trailing 12-month free cash flow stood at $46.34 billion. The company held $53.17 billion in cash against only $12.81 billion in debt. These numbers illustrate immense pricing power and cash generation. NVIDIA's growth is no longer just about the 4 big cloud providers. 5 new engines are emerging. Sovereign AI, governments building national AI infrastructure, already reportedly over $30 billion in revenue. Industrial AI, partnerships with Siemens and Dassault for industrial operating systems. Agentic AI, Jensen Huang says every company will become an agent company. Physical AI and robotics, platforms like Cosmos and ASIC GR00T, with partners like Boston Dynamics and Caterpillar. And local AI PCs and autonomous driving, the Drive Hyperion ecosystem expanding to Tier 1 suppliers. These markets could redefine NVIDIA's addressable opportunity. So where does this leave NVIDIA? In the short term, 1 to 2 years, its position is unassailable. Rubin is expected to ramp in the second half of 2026, and the CUDA plus full-stack plus networking Moat has no real rival in training. The medium term, 3 to 5 years, is the battleground. Inference shifts to ASICs, and NVIDIA's market share goes from monopoly to dominance. Gross margins may drift from 75% toward 70%. The long-term winner is whoever defines physical AI and sovereign AI standards. If CUDA extends into robotics and industrial simulation, NVIDIA becomes the operating system of the markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.